This was the biggest volume spike of the day, and it's a red candle. Looks bearish, right? Wrong. This actually kicked off a rally. Let's break down how to read volume so you can tell when it's real and when it's a trap. Volume, in simple terms, it shows how many units of an asset like shares, contracts, or tokens changed hands
and how active the market is during a specific time frame. But here's the twist.
That monster spike on a 1 minute chart, it's huge. On a daily, it's nothing. Volume only means big compared to what's around it. But it's not just about the bars on your screen. It's about what's normal for that asset. That's relative volume. Quick way to see it, add a moving average to your volume. I use a 20 periods on a 1 minute chart. That's the last 20 minutes of normal activity. Anything above that line stands out instantly.
So what does volume really tell you? First, liquidity. In an active market with high volume, orders tend to get filled faster and at a price closer to what you expect. When volume is thin, the price can jump around more between trades, and you might not get the fill you were hoping for. Second, conviction. If price rises and volume swells, it usually means the move has real participation behind it. Price rising on a light volume, that push might not last. Third, attention shifts. A sudden volume spike might be news, a breakout, or a key level in play. Fading volume can signal interest leaving. Here's a simple rule of thumb traders use to read price and volume together. Price up, volume up, that's strong buying. Price down and volume up, that's strong selling. Price up and volume down, probably a weak rally. Price down and volume down, that's a slowdown or a possible bottom. It's not a guarantee, far from it. Think of it more like a weather forecast. It won't predict the future perfectly, but it can give you a sense of whether the market's heating up or running out of steam. The basics are a great start, but the market is rarely that simple. Let's break down a scenario where the price is screaming sell, but the volume is quietly telling you to get ready to buy. Here we have a crystal clear support level. You can see the price has hit this floor multiple times, making it a critical area the traders are watching. Now watch what happens when the price drops sharply to test this level. The immediate reaction from many is fear that the support will break, but the real story is in the volume. An absolutely massive volume spike comes in right at the low, signaling a major battle between buyers and sellers is about to happen. But you know what? Let's watch a market replay of this exact moment. The market is stable, but in these quiet periods, stop-loss orders from traders often start to build up below the recent lows. It's what we call a pool of liquidity. Now watch what happens when a large sell order hits the market and breaks that initial floor. The initial move triggers a chain reaction of automated sell orders, creating a wave of forced panicked selling that feeds on itself. But look at what happens as the price reaches support. It doesn't just stop, it pushes right through it. This isn't a sign of weakness, it's a professional move called the stop hunt. It's designed to trigger all the sell orders sitting just below the support line, creating a flood of liquidity for large buyers to fill their orders. And that is where the absorption happens. Think of it like a massive thunderclap. You don't need to see the lightning to know it was an immense release of energy. This volume spike is the sound of that panic being met by an even larger opposing force. In trading, this is a key concept known as absorption. It's the act of large buyers soaking up every sell orders to defend the critical price level. Right here is the moment the selling is exhausted, the downward momentum slams into the wall of buyers, and the panic is completely sucked up. So the main takeaway here is that support and resistance levels are only useful if the market respects them. Volume helps you figure that out. When price approaches a key level, rising volume is a sign that traders are reacting. That activity suggests the level matters and increases the chance of a technical bounce or rejection. Another key level volume helps you spot is breakouts or fakeouts. Breakouts happen all the time, but many don't go anywhere. Volume helps you tell the difference. When price pushes through a key level, rising volume shows that traders are stepping in. That participation supports the move and increases the chance of follow through. Volume won't confirm every move, but used well, it helps you filter out weak breakouts and spot when a trend still has room to run. Bull markets are born in panic and die in euphoria. At the extreme of both, volume often explodes, marking what traders call a capitulation. A bullish capitulation usually happens at the top of a strong move, when short sellers give up and buyers pile in. Volume spikes, price surges, and then a correction follows. A bearish capitulation is the opposite. It often occurs after a steep drop, when buyers finally give up and exit in panic. Volume spikes again, but this time the selling dries up and price begins to rebound. These moments aren't always easy to trade in real time, but if you spot a volume spike after a sustained trend and price stalls or reverse, it is often a sign the move is exhausted. Raw volume alone can tell you a lot, but the volume indicators help you go deeper. Here are some of the most popular ones. Now here's the thing, most pros don't stack 10 indicators, they use 1 or 2, just to confirm what they already see in price, key levels, and volume. Because once your chart looks like a Christmas tree, your edge is probably gone. Want me to actually break these indicators down and show you how to use them? I'll cover that in another video, so hit like, drop a comment, and subscribe so you don't miss it.